Welcome, everyone, to another episode of the New York Alternative Investment Roundtable Lunchtime webinar series. My name is Jason Eisman, Assistant Vice President at Hub International and moderator for the webinar. Before we get into this extremely exciting discussion on financial centers, how they direct the flow of capital, their use case for family offices, and the future, including AI, I just have a few housekeeping items that I want to go through. First, for those of you who are unfamiliar with the Roundtable, we're a nonprofit organization whose mission is to provide a forum for thought leadership and knowledge sharing in the alternative investment industry. We do this by hosting monthly in-person events and monthly educational webinars, such as this one. Everything that we do is as a result of the support of our sponsors and members. If you're interested in learning more about becoming a sponsor or becoming a member of the Roundtable, you can reach out to me, or you can go to the website ny-alt.org. This webinar is going to be recorded and it will subsequently be posted on the Roundtable's website for future viewing. Last but not least, if you have any questions that come up during the discussion, please use the Q&A function at the bottom of your screen. You can log your question there, and at the end of the presentation, we'll open up for Q&A and we'll answer the questions in the order that they came in. Without further ado, I'd like to introduce you to Kerry Ann. Kerry Ann, take it away.
Thank you, Jason, and thank you everybody for joining us today. My name is Kerry Ann Sullivan. I'm a partner at Hilton Global Investigations. We partner with financial firms as they conduct due diligence on their target investments and opportunities. And I would like to take a second just for Christian and Jonathan to introduce themselves as well. So, Christian?
Hi, good afternoon, everyone. Chris Cameron. I work at the Dubai Financial Services Authority. That's the DFSA. We've got responsibility for regulating the financial services firms within the DIFC in Dubai. Nice to be online with you all today.
Great.
Over to me. Hi, everyone. An absolute pleasure to be speaking to you today. I'm Jonathan Beardall. So I'm Head of Wealth and Asset Management for the DIFC Authority. I'm responsible for the global business development for the wealth and asset management sector, which includes pretty broadly for all of the alt space, hedge funds, private equity, etc. And it's the largest sector that we have in the DIFC. And it's just going to be great to talk to you about it today.
Thank you so much. We're in great company and so happy to be speaking with you both. So just to set the stage, financial centers are competing for capital, talent, and innovation at a time when capital is becoming more mobile, family offices are more influential, and AI is reshaping financial services. Today, we're going to explore what defines a modern financial center and where the next opportunity lies. So I'll just ask a starting question to you both. Anybody can jump in, either one of you. When you think about the modern financial center, what is the one defining characteristic that matters most today, in your opinion?
I'll jump in if that's okay, Chris. I think for me, it's connectivity. I think having the freedom of not having legacy, I think is something that's really important. But ultimately, connectivity, it's not just somewhere where transactions happen, it's where there's proactivity, innovation, but a trusted regulatory environment really helps. But it's about listening to what your clients need and helping to build a legitimate framework around that. And things like geography really help, especially for someone in the Middle East.
I'll add, kind of connected to that as well, is ecosystem. I think we've got the benefit of being a mature financial centre now at 23 years old. So you've got a broad and deep ecosystem. Every player that you would require across the whole financial services sector through banks, securities and insurance firms, all the service providers are here. So you've got that whole ecosystem within 110 acres big currently, but planned to be 3 times the size. And then I think if I was to just highlight one further point that really is coming to the fore within the DIFC in Dubai now is time zone, because it's really resonating with so many people, and that's an attractive point to move here. You can have Dubai within your global footprint, but you can have access to markets all day long, and actually, really importantly, still have a very nice work-life balance whilst having access to East Asia all the way through to the US in one day. So that's resonating a lot with people coming to the centre.
Great points. Um, Financial centers used to compete primarily on geography and tax efficiency. Today, in your opinion, what actually differentiates a successful financial center? Is it regulation, connectivity, talent, capital, quality of life, legal systems, or something else? I know you just touched on it a little bit on the previous question, but maybe you could include, what do global firms evaluate first when they're deciding where to establish regional operations?
Happy to go first if you want, Jonathan. Yeah.
Sure, go
I
on,
think, I
Chris.
think, I think key from my side of things would be the legal framework as well as regulatory framework. So you've got a UK common law legal framework. So that gives anyone, whether they're moving in entirety to Dubai or just adding Dubai to the global footprint, most people have worked in that type of jurisdiction, that legal framework, beg your pardon. So they're comfortable, confident with it. And then equally the regulatory framework, we map back to international standards as well. So anything they're used to seeing in US, Europe, East Asian jurisdictions is going to be very familiar. It all maps back to the same principles. We pride ourselves in trying to make it easy to come in and set up using those legal and regulatory systems.
And I think if I could just add to that, Chris, and carry on, it doesn't come quickly, and I think ecosystem strength is the differentiator. The DIC is 22 years old, but it didn't start as big as it is now. It takes time, but when you've got a depth of the infrastructure that needs to be world class, and that has to be important when you're competing with the likes of the established centers like the New Yorks, London, Hong Kong, Singapore. So you need world class infrastructure. You need the tax efficiency, which obviously we have, but that's not the big draw card for somewhere like the Middle East anymore, and that's the broader Middle East as well. It's that familiarity that Chris has been talking about, having the legal framework. When people know or pretty much know what the legal system is going to look and feel like, that's really helpful. And there's also a bit of following the early movers pattern as well, because if you're part of at this stage, and people who worked with me have heard me say this many times, there's only 20 firms in the top 20. So, but when you're the 16th or 17th firm that's not there, there's a little bit of that. Let's follow and see what's there. And the reasons for coming and that competition, it changes all the time. It used to be we want access to X, which might have been sovereign funds. It might have been some other wealthy families in the region. But now we actually want to come and compete for talent. The talent pool is there. And you must have a talent pool because it's when people look at it as a serious place to do business. And that's certainly been probably the last 6-7 years where we've really seen a big tightening, a really big upshot in the talent there. So people come to poach who's there, which is great. We want a free market. People bring depth of operations, which all becomes a sort of self-gravitational ecosystem. And we sort of got past that point where everybody knows that this is a serious place. And when other centers are doing it, they can also do the same thing. But you can't rush a financial center. You've got to build it with a really long-term strategy. You've got to have your 5, 10, 15, 20 year. The DIC Zabila extension doesn't complete till 2040. So that we've got a really long-term vision all the time, always. But you've got to measure against that. But you do just get to a case where you can compete with these things, but only, and the word ecosystem is probably going to be used 100 times in this webinar because it is absolutely crucial. And when you've got the legal support, you've got administrators, you've got fund admins, you've got all the things that you're used to in another established financial center, then this might be the right time for someone to come and look and explore. And I think the last sort of point I'll make on that is when people are setting up financial centers or they're evolving their existing financial centers, it's important to look at a global map, not necessarily as competition all the time. Actually, it's about complementing your existing framework. If you've been sat with an office in New York and in London and then all the way over in Asia, I think there's been a demand to have a serious place to do business sat right bang in the middle of the world on the time zone that Chris has mentioned as well. So actually, we're part of a complementary global footprint, not how do we compete with New York? How do we compete with London? Actually, how do we add to someone's broader global expansion and make them even more successful? Because it's not a zero-sum game. There are benefits to be had at looking at the modern financial centers.
Very good, very good. What do you think, just to follow up on that, what are firms often surprised by when they're entering a sophisticated regulated environment like Dubai? Could you speak to that a little?
I'll speak first. I'll speak on Chris's behalf a little bit, so he doesn't have to say it himself. I think the thing that people are probably most surprised by, and certainly the whole wider client book, is the open for dialogue regulator. I mean, he's sat on here now, right? And Chris is one of our most senior people in the regulator. But the regulator want to listen to the ecosystem. They understand our risk tolerance, risk framework. They will map things to international standards. But I'll use this example quite a lot. Chris and I travel together quite a bit. Actually, we've been all around the world together, and it's really useful. So when you're in the business development team bringing firms in, great. But if a firm says, "But actually, that this regulation doesn't necessarily work for us," well, it's fantastic if I've got someone from the DFSA sat with me and tell me more. What do you need? And a good example of that. Last January, we were at the Global Alt Conference in Miami, and Chris and I and a number of other members of the senior team were meeting with one of our top hedge funds, and they wanted to move more staff there, but with our private credit rules and our crypto regs weren't up to scratch from what they needed. But hey, presto, we've got Chris in the room. So we go back, the homework's done, and then I think it was October, private credit was all renewed, and I think it was January this year that crypto was. So we can write our own laws, we can move at speed. We want to be pro-business, but not at the cost of just trying to be everything for everybody. It's got to sit and map against international standards and sit in the risk framework. And I think people are generally pretty stunned at that. And just a slight add-on, because it amused me at the time, because Chris will remember it well. We didn't tell this particular hedge fund Chris was coming with us. So you can imagine a US-based hedge fund, when a regulator walks in, different reaction to what we're normally used to, but soon learn that it's a positive experience. So I will speak on your behalf on that one, Chris, but if you've got something to add, please.
No, I think that was well put. We try our best, I think, but I do think genuinely it's important that listening in is the greatest communication skill that we all have. But it is important that we spend time. I think one of the benefits of being in the centre is that we are all together. And yes, of course, there's going to be situations where we maybe need to talk about remediation. There might be the odd enforcement case, which is important because that sets a standard. But the most important bit alongside that is working with the industry to find solutions. And I think Jonathan mentioned a really key point there, is that we don't have our agenda set by anyone else. We have the ability to create as well as revise our own laws and our rules. Of course, we'll take on board stakeholders, key stakeholders like the DFC authority, the ruler, the government. If they've got things that they would like us to look at, we'll go away and have a look, but we'll create that, as well as we'll map back to international standards and look for enablers. So first and foremost, as a regulator, is looking at risk. They're looking for enablers for business as well to support the DFC's strategy, and also Dubai's D33. That's their economic sectorial strategy for the next decade as well. So we look to facilitate that as well as look at the risk piece. But listening to our stakeholders, whether they're here already or would like to come, but there might be a blocker, is really important.
Thank you. Thank you for that. I'm glad to hear you didn't scare the hedge fund away. So sounds good. Either one of you could take this one. We're seeing shifts in global capital flows due to geopolitics, economic fragmentation, and changing investor priorities. What are the biggest forces reshaping where capital chooses to locate today? And I know Dubai's been a hot topic in the news for a while, so I'll let you talk to that.
Yeah, look, I'll talk back to we've got an overarching responsibility for the family office and private capital piece as well. And I've spent time in my career running family office networks. I'm pretty well connected to that capital movement. I think it's evolved. I think it's smart money is certainly more the case with family offices, especially those that have been legacy with. And if I'm talking specifically about the families, the Gen 1, Gen 2 piece, which was hard to crack into for a lot of managers, now it's moving to Gen 3 and onwards. There's a different investment appetite. And ultimately, family offices pre-COVID were generally as exotic as the family office structure is set up in some regional proximity to wherever the most competent hub is, to where the family is from, plus a manco, a holdco somewhere else in the world to hold some real estate assets, maybe. And that's probably 90% of family offices. Whereas I think the pandemic really changed the face of where capital started to move, because I think a billion-dollar family has now probably got 4 single family offices set up in different parts of the world. And they've probably all got, crudely $250 million in each. Because I think part of it, geopolitical tension is one, and that is everywhere. The reality is, so there's an element of concentration risk. there's accessibility risk as well that people see. Plus, capital is more mobile because people are even more mobile than they ever have before. So why not have part of your structure set up where member of the family is? And if you're in a jurisdiction that makes that very easy for people to either move from a human capital perspective or private capital, that works. But then that capital doesn't move unless it feels it's got access to opportunity, which means that's why the managers come, because if the capital and the structures are there, they need to be serviced by someone. And that's why we see a lot of the global managers that everyone's heard of all moving in.
Mm-hmm. Mm-hmm. Chris, I don't know if you have anything to add.
No, I think Jonathan's covered that, all the points that I would have mentioned there. It's good.
Good. If you could look at 5 years from now, what will separate leading financial centers from those that may fall behind? 5-year outlook.
I'm happy to go first, Chris. Do you want to take it?
Yeah.
Whoever has the crystal ball, feel free to
the crystal ball. Yeah, the 5 years from now, it's a fantastic question, because I think if you said 5 years ago where we'll be now, I don't think anyone would be anywhere close. But I think it comes down to one or two things for me, maybe even a third. Trust one, so that regulated framework, the legal system, that's a hygiene factor at this stage. So I think that is the case in most places around the world. But then it's talent and adaptability. I think they're absolutely critical. So taking on, AI has been mentioned at the top of the session. AI is becoming very hard to ignore, and we'll talk about that more and more today, I'm sure. But those who are embracing innovation rather than being scared of it, that doesn't mean take it all on. It means look at it piece by piece, understand it first, but certainly be open-minded enough to bring that into part of your situation. I think that's where centers will leave. That 5 years will feel like 10 years, 5 years ago, because I think things are moving so quickly. If you don't keep up with that momentum, it's really easy to fall behind.
Yeah, I'd agree with that. I think innovation is the key bit, and that's very much central to both our authorities' plan and view, and it supports the Dubai government's vision as well. Whether that's looking at the frameworks we put in place for digital assets, kind of early look at AI with our industry, and even things like tokenization. See if you can get that kind of a start to end point, which that's a much longer term. But we've looked at frameworks to try and enable these things, and again goes back to that engagement piece, working with the industry. What do they need? What would the government, what would the country like to see in place to put it at the forefront as well? So I think innovation is definitely key, and go back to that engagement piece as well as part of that, just listening and discussing and understanding what's needed, as well as impediments and blockers.
Perfect. We'll shift gears a little bit to talk about capital flows and the next wave of opportunity. So where are you both seeing the strongest momentum in financial services growth today? Private wealth, fintech, alternatives, insurance, digital assets, something else, capital markets?
It's the cop-out answer is all of the above, I think. But I think the ones that are sort of sitting at the sharp end of the spear at the moment are those with something a little bit different to offer. Like private capital is becoming the big thing to talk about, and whether that's looking at things like private credit, private markets, etc. But private capital is incredibly important, and the wealth is growing at speed. And obviously, there's that comes with the family offices. And I think where that marries really well is with the alternative space. I think it's a lot more interesting for people to see what else is out there when they're looking at their global portfolio. How many more $1 million do they want to invest in something that's almost the same as they've got sat over here? So I think because the investment ecosystem is so broad now, if you think of what when tech first became something to invest in X amount of years ago, now tech is now 100 different things on its own. So there's so much optionality for people that if those who either been wealth creators or wealth inheritors, they can invest in things they actually really want to, rather than stick it into X fund with X return per year. So they can sort of meaningful investments and not just being entirely alpha driven are important. And the alt space is what absolutely covers that off for me. And I think it's going to become more and more important. And when you see the AUMs that have been allocated into hedge funds in the broader alt space every year, it is increasing. It's becoming a bigger percent of allocation. So I think that's where the capital pools are going to see the most sort of dynamic change, and the portfolio makeup within them, I think, will look very different today than it did 10 years ago.
Yeah, I'd agree with that. And I think just to support, that's probably the newer area for the centre post-COVID. It's hedge funds and alts. You've got well over 100 hedge funds in the centre now. So that's definitely the newer area. But if I look at our licensing pipeline since COVID, there's not a part of the sector that hasn't increased or grown. And I think equally as important as new firms coming in is actually the expansion of existing firms. And what you're now seeing is a move to setting up the DIFC as a hub for a region. And that region in itself is expanding constantly. It's a much bigger geography in terms of both clients and opportunities. So I think it's just, as we said at the outset, broadening and deepening of the DIFC has been quite exceptional in the last 5-6 years. It's certainly at the forefront of that. I think the hedge funds have driven a lot of the positive change because it caused a ripple effect across this ecosystem. Whether you're a legal firm, a compliance consultant, a fund administrator, they've all parachuted staff in to support that growth, to be on the ground next to them. So it's been a key change.
Understood. When new sectors emerge quickly, and Jonathan kind of alluded to this earlier, whether it's digital assets, tokenization, or AI-enabled financial products, how should regulation evolve without slowing the innovation? Obviously, there's been so much change so rapidly, even since January. So I don't know if you want to take that hot topic.
Chris, I will hand this one straight to you.
No, look, I think it is a challenge, and it's one that we've confronted head on. So if I go back to, it's probably you've mentioned a few key topics there: tokenization, AI, and digital assets. If I look at digital assets, I think 2021 we introduced our tokenization regime. The year after then, we introduced our crypto token regime. So looking at creating a regime specifically for your Bitcoins, Ethereum, Litecoin. And also a criteria for tokens we weren't keen on. Now, that was the implementation, creation and implementation. And we were probably ahead of most regulators and most jurisdictions in allowing it. And by creating a regime, you're enabling it and marketing that you can come and do business. There's always going to be someone feels that that wasn't enough and it wasn't liberal enough. So again, working with industry, understanding the fast pace and what was in the centre, and equally us sharing our concerns on risks. So it was a two-way exercise. Meant that the following 3 years, we were able to shift the risk tolerance each year. So I think 2024, we looked at liberalising the fund regime to enable more crypto funds. Then last year, we didn't rip the whole regime up and start again, but it was such a significant shift in risk tolerance. We moved from a centralised recognition of crypto tokens where we recognised about 9 tokens, which doesn't sound a lot, but it did enable about 80% of the volume of the market. But again, we listened to feedback and we decided to remove ourselves from that. And again, it was through our experience and getting used to the sector, whereby we now enable a firm, if they've got a license to do crypto, whether they're dealing, managing, advising, marketing, then as long as they've got a license to do that, then they carry out a suitability assessment of each token they want to provide a financial service on. So it's putting the onus on the firm, but trying to enable business, taking a more risk-based approach. So, and through the heart of that was innovation. We've done the same with tokenization. Last year we had a tokenization sandbox, and that was to attract new business, raise awareness you could do it in the first place. We had about 100 applicants. We took through about 17. An innovation testing license, ITL, is a key part of what we do in a broader financial service sector, but that focused purely on tokenization and trying to use that kind of innovation piece for the centre, because the DFSA authority, the authority that Jonathan works for, they've also created a kind of AI hub. There's an innovation hub, beg your pardon, an AI campus to support that. There's a healthy number of innovation firms, not just regulated, but unregulated in the centre. So it's a key part of what we pull together as two authorities to facilitate.
Sounds collaborative. Jonathan, I don't know if you have anything to add to that, or Chris covered. Okay.
All good, thank you.
Great. So we've talked a little bit about this, that there's just so much competition among global hubs for talent and investment. What makes firms stay and not just come and remove themselves? What makes them stay?
It's got to be a mutual value creation. The ecosystem needs to be self-fulfilling past a certain point, and initial attraction to come set up in any jurisdiction is generally based on one or two things, either operational. So when I look at the alt space, the first wave and the hedge funds came because they came as portfolio managers. They weren't raising capital. They came to do follow the sun model. Basically, that's why they came. But that was their initial reason. Others have come to capital raise, whatever they may be. But if there isn't a longer term strategy, building a license because one PM wants to move isn't a long term strategy. Coming with an investor relations guy and thinking that's going to fill your pockets in all your other global offices, that's not why you stay. You stay when the ecosystem is one, making you able to grow organically, which means either you can attract talent, fantastic, either you are raising the capital, or beyond that, and something we're seeing increasingly is you're seeing investment opportunities as well. The region's huge. When you've got access to the India market, just a couple of hours one way, you've got the whole Africa region just below us as well, and most of it on the time zone or plus or minus 2 hours in either direction. So you're starting to see more and more, and I think again, it's the word ecosystem, but because we've got this captive space of it's 110 acres, you can walk across it in 15 minutes, which means you can go see everybody that you want to do. It's not as sort of fragmented as if I'm in the UK and I've got one guy sat in London and one sat in Leeds, or in the US, New York, East Coast, West Coast. They're all together, so you've got accessibility to it, and that includes the private capital, the family offices. Offices are in there as well. So I think that sort of hub of being able to create that value exchange is really important, because actually it's just as important to us that you succeed and you stay and you grow, because ultimately all of our KPIs are around GDP growth reality. I might have 50 others, but that is really what we're looking to do and drive the overall performance of a country and broader region. And you only do that if people stay and they grow and they become deeper. And we try to be facilitators of that, but ultimately it's about the firm. If you're going to sit with your door closed and expect people to come knock on it, it ain't going to work. If you're going to get out there, be visible, engage with the market, you've got a really good chance of succeeding.
Chris, anything to add to that? Any mistakes that you've seen that you could talk about when someone's entering a new market? What would be the biggest mistake to avoid?
Yeah, look, I think it's not a requirement to have one, but I think certainly if you're not associated with the region previously, getting a service provider to support you through the application process, compliance consultant, if you're setting up funds, maybe a local legal firm, all the big global names are here, they're on the ground. So in terms of fund documentation, and that just gives you a little bit extra support in setting up, but also just talking to myself and Jonathan or our colleagues or our teams. As Jonathan's mentioned earlier, we're open for dialogue, and that includes before you come in as well. And whilst you'll hear regulators say we can't advise you or go and get your own legal advice, okay, that's true, but we will openly give you feedback and guidance, because to Jonathan's point, we want to see the vast majority of people come in and be successful. So I think it's important to have that conversation up front.
I think if I could just add to that, I think the biggest mistake anyone makes in expanding anywhere globally, and obviously we're a little bit Middle East heavy, and don't make too many apologies for that. Is where we work, but whether you're a Dubai-based firm or an Abu Dhabi-based firm expanding to London, the pitfalls are the same. If you've not really thought through your strategy as to why you're there and a real 5-10 year and beyond plan, whether that's successful or not, you need to really think it through. Coming at the wrong time for your business, it becomes more luck than judgment. So I think if people, I mentioned earlier on around if there's all the big managers there and you're the one or two that are missing out, maybe you come for the talent, but at least that's still a viable strategy. I think where people come just because they're looking in other parts of the world and going, that looks cool and shiny over there, there's loads of money, that looks like the ATM to the world, which we then if I come, I'm gonna get rich overnight. It's just not the way it works. So I think sort of rushing to a strategy, and if your timing's right today, great. If your timing's right in a year, great. If it's 2 years, great. And that's any expansion of your business. When you're setting up a remote office or you're starting up a business, it is the hardest thing you will ever do, because you're trusting a detachment from your existing hubs that are tried and tested. So if you've rushed into that, you've not got a great chance of succeeding. Some muddle through, But I think that's the biggest mistake that I will see.
I'll also just add, if you
Very
don't mind, on the
important.
growth piece. We did a thematic review last year because of the kind of high growth phase that the whole of the centre has gone through post-COVID. And we thought it was important to get a few key messages across. Most of our firms were actually in a fairly good place, so it was a good exercise. One of the key points was growth is great, and we're not against that. We'll support it, facilitate it as best as we can in the regime, but it should be in a controlled and sustainable manner, to Jonathan's point. So, whilst you're maybe looking at front office to go and get out clients and opportunity, making sure that you've got the right support staff alongside back middle office, risk, compliance, AML functions is one of the areas that we've also just highlighted. Often if a firm, and this could be anywhere globally, goes on a surge of onboarding new clients, sometimes the resourcing, the planning's not there, and the control framework doesn't keep aligned with it. And then if there's remediation, that can be costly further down the line. So again, it's just to try and facilitate and get people off to the right start with that key messaging that we did last year. And that's publicly available on our website if anyone's keen to read it.
Yes, I was just going to ask you if that was accessible. So thank you for that. And we can make sure people can find that at the end. Okay, we're going to shift gears slightly to family offices and family capital. So family offices have become far more influential in global capital markets. What is driving their growing importance, and how are their investment priorities changing, again, in your opinions?
Okay, I'll start with that one. I think, look, family offices, it's funny, there's an overused phrase, I'm sure, but once you know one family office, you know one family office, right? So that they're all so incredibly different. And I think I mentioned a little bit earlier about that sort of difference in investment appetite because of the way that the capital has gone through generations. So I think, if I look at regional families in the Middle East, if you wanted to come to the Middle East 5 years ago and pitch to a 90-year-old patriarch who's made all of his money building apartment blocks and hotels, and you said the letters A and I next to them, good luck. I'd love to see that conversation. I'm sure that went really well. But maybe those that are inheriting the wealth, it's different. And I think family offices have become way more institutional. And I think there's a number of reasons for that. One, I think I said the phrase earlier, smart money. I think the money's becoming more and more institutional in the way that it's managed. People have their full investment teams behind it. It's not just patriarch, matriarch that's sitting on the top of a pile of wealth that's from a successful business. And I think that's where the great deal of family office wealth has come from. I think the thing with family offices, they've always gone through this. The first panic is, how do we keep the money? Wealth preservation is absolutely the number one panic with everything. And inevitably, shirt sleeve to shirt sleeves in 3 generations when you try to do that, and you don't think about investing it and getting the right return on those investments. So I think, especially when there's so many interesting opportunities in the alt space, whether that be PE, hedge, when you're looking at private credit, venture capital, even venture capital goes up and down from whether it's a capital winter or whatever it is, but it's still interesting for people, and ESG and all the opportunities are out there. So I think the portfolios are bigger, broader, less concentration risk. And part of that is the family offices have got such incredible wealth now. What used to be looked at as a family office with $50 million is now $5 billion. So they need to manage it properly. And for some of the families out there, they're competing with some of the managers for talent as well. So it's a very different landscape. And ultimately, they're looking to allocate in ways that are going to, as I say, one, preserve that wealth, but two, they want to grow it. And they want it to continue to be generational.
I think just to support that, I saw that firsthand last year when we went to Miami. We did a round table with one of the banks in the DFSA who's got a prominent position out there as well, and they took in a number of their clients. And I remember when we did events globally years ago, you'd have to explain not so much Dubai, but what DFSA was. These people come in very well versed in DFSA, which tells us that there's a better awareness. But actually, the manner in which they explained about their global structures, the footprints, and adding Dubai to that showed a different. It was certainly a game change since COVID. And to point to that, one of the reasons I could see that was there was a point in time where the DFSA registered and regulated family offices under our DNFBPs, or designated non-financial businesses and professions. But we took the view to make sure that we're better aligned from a FATF perspective to remove ourselves from regulation of single family offices. And now the remit sits under the DIC authority. Unless they go to be a multi-family office and hold themselves out to third parties, then they would come in under our remit. But there's been a massive expansion in the DIFC. I think, what are you up at, 1,400 now, Jonathan?
Yeah, for 15, 1,600 family office structures, up from 200 2.5 years ago. So Chris and his broader team are probably thrilled they don't have to regulate that kind of number now. It's funny, whenever we say non-regulated, family offices aren't regulated everywhere. Actually, most global hubs said they are not. Somewhere like Singapore, they're regulated very deeply. But the reason that the DFSA authority looks after it now is because we've got the onboarding and the due diligence, the world checks, all the usual sanctions recognition that the regulator has. So we were doubling up work. So actually, for when a family is looking at something like Singapore, where it can take 18 months, 2 years to get set up and structured, it can be set up in under a month in the IFC. So that speed is there, but ultimately the family offices still want incredible structuring. So you can make it really quick for someone to come in, great. But is it the right structure? Is it globally recognized? Is it familiar? Does it interchange with what else we've got around the world? If you've got that, you've got a really good chance of attracting that capital.
Do you find them the family offices focusing on privacy? How do you balance that with the transparency and governance?
So it's an interesting one because it gets, especially because when we were studying in Miami, it was a lot of Latin American families, as you would imagine, and obviously there's been some privacy issues in South America and Central America, as we know, but the family offices in DIFC can elect to go on a private register. So and almost all do, because privacy. We sort of took a view, and some of this is my sort of personal anecdotal opinion. A few extra commas in your net worth shouldn't mean that that's public information as to what you do with that capital. And actually, privacy is a pretty cultural pillar in the Middle East, and not, and it is in most places, but there isn't this force for transparency. As long as all sanctions are being followed, the money's been invested correctly, and the structures are all set up properly. So those, and we take that really seriously. So I always enjoy sharing this because we keep the privacy so seriously. We have 2 offline digital vaults that we have at DIFC for our client data for families. One has got the client names, one has got the all the structures and the assets, etc. in it, and they're not together and they're offline, so they can't be hacked. I would say can't. Someone will prove me wrong, I'm sure. But that's, and you need, and we don't know where they are. Very few people do, but you require 3 keys to get into either of them. And when you only need 2 to launch a nuclear weapon, that sort of tells you, tells the seriousness of that. But that doesn't mean it's hidden. It just means it's not shared. And I think that's key, and that's really key to understand. So it's not a place where people are just putting capital that they don't want people to know about, because again, when you are one of the top 7 financial centers on the planet, you can't have a hidden vault that's got things in there that shouldn't be. So it is all clean. It's just not in the public domain. And I think when you are quick to market or quick to get into market, and you have privacy, that's got to be appealing for families. And I think that significant growth over the last 2.5 years will only continue.
Yeah. Chris, anything to add to that?
No, I think Jonathan's covered all that. As I said earlier, most of or all of it now sits under DIC authorities' remit. So, but a massive growth. But I think one point I would mention actually is there's a lot being done to connect the family offices with the regulated institutions, because that 1,500, 1,600 that's just kind of sprung up over the last few years. There's a lot of potential in there for clients, for the hedge funds and wider wealth asset management sector. So there's a lot of platforms that the IC authority predominantly is putting in place to introduce people and have maybe an awareness raising session just to start networking and get them all to meet each other that way. So there's a lot just to pull them all together to foster further business.
I like the way Jonathan explained the privacy somebody who operates in public records and transparency. I thought you explained that very well. So thank you for that. If we're looking at family offices, what is the most important thing or some of the most important things to them in a financial center? Is it access to the deals, succession planning, global structuring, lifestyle? Again, you've touched on some of these things. Is there stability that you've been hearing come up more and more?
Yeah, I think stability, access, expertise, investment opportunities. The list is pretty long, but I think in reality is when it's that familiar framework again. And actually, we've looked at the um, what are the best offerings for family offices globally? If we don't have it, should we go copy it? Should we go find the best bits and make our own version of it and launch that? Why did Singapore do so well? The VCC, the Variable Capital Company framework they launched, rip roaring success. We just launched ours. So it's the ability to do that. So that, but the access isn't just access to the capital and access to opportunity, it's access to the managers. Because for families, one of the frustrations that they have had over years is fly in, fly out, briefcase banking, basically, which has worked and will continue to work to varying levels of degree, depending on how deep your client relationships are. But if you were coming to somewhere like, and I'm not just talking about Dubai, the broader Middle East, people fly in, fly out, and that worked because the families there really didn't have any other option than to invest with you because they didn't have the institutions on the ground to invest with. Now, there are 600 plus managers sat within DIFC today. So if you're brand new to the region and you come fly in, fly out, and you come in once every 6 months, good luck. Because one of your peers has got an office over here. So the family office wants to be able to come knock on the door and come meet with Steve or Sarah, and they want to meet them on Monday, not in 3 months face to face, not always digitally. I want to come look, feel, shake hands. I want to sign a wet signature. And I think Chris and I talk about this quite a lot. We've done over the years a fantastic job of telling the managers we've got loads of private capital. What we hadn't been doing is telling the families with them under private capital we've got loads of managers, and which is just as important. And the bits that Chris was alluding to, we have something called the Family Wealth Centre. So actually, we do soft infrastructure training for people, and it's principal for family offices. We host a lot of the events, and we do them sort of weekly when the weather's good in Dubai. One of them will be on succession planning. So it's not about sales pitches and having someone talk about the last 3 years fund performance. We did one in September last year called "What is a hedge fund?" Because the families are hearing about them all the time, especially in the press in the Middle East. But actually, the answer to what is a hedge fund is the same as what is a family office. One, you know what, when you know one, you only know one. So there's so many different types. So how to navigate that world? You've inherited $500 million. You've no idea how to invest it or what these products are. You just hear in names. So actually, doing succession planning pieces, doing family office constitutions, and bringing in experts to help guide these people and to introduce them to the ecosystem, whether it be events, procured one-to-ones, whatever it may look like. And my asterisk to that is what we don't do is do cap intro meetings, because I don't think that is what a credible centre should be doing. But we create an environment for people to meet, should they wish to. Some don't. And you know what? That's fine. Some want to be private and do their own thing. But others actually want to meet an ecosystem and they want to come see who's out there. So I think that works really well. And one of the things with the family offices and why it works really well with alts is I think they've got a longer time horizon. I think institutional investors, I think there's just a slight difference in the investment appetite may be similar for the type of investment, but actually they can be more patient. Generally, can families, has been my experience. Not always, of course, but generally they can be more patient, and then they're less likely to rip out the $1 billion they put in last year. And so it's a bit stickier. So I think that you can have a really long forward relationship with them, and that's what I think they're looking for as well. Is not just does hedge fund X or manager X have one person there who's just signing deals? What's their depth of functionality? Do they have their desks there? If I want to go speak to a prime broker, can I go speak to a cap intro team? Do they have what I'm used to them having in New York or London? And if they've got that, then they're pretty satisfied. And I think that will only continue to grow.
Mm-hmm. Mm-hmm. Chris, anything to add to that?
No, I think Jonathan's covered that very nicely, actually.
Yes, excellent. All right, one of my favorite parts of this discussion is AI, the AI in financial services. So I know myself, I'm listening to podcasts, trying to get all the language correct so I can keep talking about this and just learn from this ever changing environment and what's going on, particularly in financial services. So everything is moving from experimentation to operational reality in financial services as it relates to AI. Where do you see the biggest opportunities or risks? And obviously, this is from a regulatory perspective, but if you could speak to that a little bit.
Yeah, sure. So, look, we as an organization, like everyone else on the planet, have been experimenting with AI. For us, just to give people assurances, we're not yet or intend to assess authorization applications or enforcement applications with AI, but just to try and improve and be a little bit more efficient with our own MI internally, for instance. We've experimented a little bit with that over the last year or two. I think, as I mentioned earlier, innovation is very much key and at the heart of everything that we're trying to do with our regulatory framework. Whilst our objectives are still about safeguarding market integrity, financial stability, and consumer protection, but AI is central to that innovation with industry as well. And over the last couple of years, we've done a survey, 2024, I think it was June actually, 2024, and then again, same time last year, to all of our authorised firms, and it was registered with us as well, just to understand who's actually using it, and certainly with the first survey, who intended to use it as well. And a massive increase, real rapid increase year on year. I think this time last year, 52% of firms were using it. That was up from 33% in 2024. Most of the growth, that pronounced growth, was in, I don't think any surprise, through the adoption of Gen AI. That had tripled during that 12-month window, up about 166%, if I've got my figures correct. So it's a big area for us, but I think it's finding that kind of tempered, measured approach, that there's still risks involved, but it can certainly help and improve. And as I said, we as an organisation have tried that as well. I think if I look at it from a regulator stroke compliance perspective, there's definitely opportunities, things like enhanced financial crime detection. I've managed the conduct team now since 2013, but I had a 5-year spell during that period where I also managed our financial crime prevention team. So we've had a lot of vendors come in and talk to us, and we've thought about it a lot internally as well. What could we use? What could the industry benefit from? And I think with financial crime, you've got use of machine learning that can dramatically improve the ability to look at complex AML or money laundering structures. Take that a step further, looking at big data sets for insider trading, market manipulation, and even just broader in our kind of day-to-day in the conduct risk space. The ability perhaps at a point in the future to be able to look at conduct risk, looking at consumer files, for instance, big data sets that would take us a long time to go through if we're out inspecting a firm, whereas that can be done fairly much instantaneously. So I think there's definitely a lot in there in terms of opportunities, even just the wider risk management piece with subtext solutions, from our reporting, reducing human error in terms of reviewing data sets, and also lowering kind of that long-term operational cost. So there's a lot of opportunity in there, but obviously still quite new, so a lot of inherent risks, that kind of black box challenge with opaque machine learning. But I think probably the big one for me is the concentration risk. There's still only a few kind of dominant AI service providers, and with that kind of brings concentration risk and that kind of systemic risk if anything does go wrong right across the whole financial ecosystem. So it's kind of that balance between, yes, there's a lot of opportunity and to be effective and efficient, but still a number of risks in there for firms and us as regulators to keep considering and getting better at each day.
Mm-hmm. Interesting. So you think more concentration risk is a concern versus the model hallucinations, which may be coming less and less. Okay.
Yeah, like
Jonathan,
I think things like your cyber risk, your model hallucinations, and bias, or they're all important. They're high risk, but probably more operational consumer focus. Whereas that concentration risk is more macroprudential. If you look at it's a few dominant AI providers, so that gives you concentration risk. Coupled with that, a lot of these big tech firms are outside a regulator's remit. So the ability for us to understand that use of them and reliance on them makes it harder as well. So at the moment, I'd probably say concentration risk, but the others are still very important and need to be considered.
Okay, great. How do financial centers remain competitive or attracting AI native firms? Is it about infrastructure, sandboxes, regulation?
I think I'll quickly answer that one from my side. I think just keep on top of it, and it's the fastest evolving, growing, and I think that's sort of half of the point with artificial intelligence. But the regulators and the authorities globally and big institutions, they need to be communicating. For a financial center to remain competitive, it doesn't mean we think we know what we're doing with this, so let's wrap our arms around it, please come here, because that on its own is concentration risk. You need to knowledge share across all of the financial centers and broader into the tech space and learn as much as you can. And if you do that and show willingness to innovate and work with those firms, as Chris has mentioned, we've got an AI campus that we're currently building, then I think you've got a good chance to remain competitive in that sphere. But the second you think you know all of it, you're already behind. So I think it's just really keep it on top of it. Do you need to build a team that's focusing directly on this? I would probably say so, because it's such a unique behemoth that we've got ahead of us.
Absolutely. I want to be able to get to some of the Q&As. Let's see, maybe we could finish this sentence. We could do a rapid fire. The financial center of the future will be blank. Fill in the blank.
DIFC.
Hard to beat that. It's connected, trusted, and adaptive.
Perfect. I think that's a perfect way to end.
That's a more sensible answer.
Well, this has been just such a great conversation. I don't know if we've got anything in the Q&A. Azara, have you been able to see anything in the Q&A that we could answer for the folks?
You're on mute, Esther.
Just so you can see.
We can give it a minute and we can see. Yeah, as of right now, there's nothing. But while we wait for people to put in any questions, I guess I have a question. Chris, can you go a little bit into further detail about regulated versus unregulated firms? You mentioned family offices are non-regulated firms. Does that mean that is there less scrutiny when they're setting up in the DIFC? Is it once they're in the DIFC, they're, I guess, trusted to do their own, they have to do their own, not diligence, but supervision with, I guess, further oversight from the DFSA? Is there a blind eye turn towards family offices? How does that work?
No, not at all. So first and foremost, Jonathan can give you the numbers. There's some pretty impressive numbers about the number of companies that were set up in the DIFC and over 50,000 employees in that 110-acre zone. The DFSA is only, I say only is perhaps the wrong word, we solely focus on the financial services activity, but there is service providers. So you've got tech companies, you've got lawyers, auditors. We register them, but we don't regulate them. It's registration purely from an AML perspective. But then there are some firms like these tech providers I mentioned, they're just completely unregulated. But what every firm does need to do is go to the registrar of companies, which is housed under the umbrella of the DIFC authority. And so they need to comply with companies law and regulation. So there is regulations for all companies to adhere to. But if they want to hold themselves out as a financial services company, then they would need a financial services license from the DFSA. whether it's managing, dealing, marketing, advising, or accepting deposits as a bank, providing insurance. They would need the financial services license on top of being licensed and set up through the Registrar of Companies.
Yeah, Chris, I'll just add to that as well for that, and because it's sort of touching a little bit earlier on around the hygiene factors of when we onboard clients and when they're investments, they still have their reporting to do. So they still have to do their AML, their onboarding, and all the bits and pieces that you would expect in any significant jurisdiction. Family offices aren't regulated in the UK; they're not regulated in Hong Kong. So this it is not abnormal practice. But yeah, all the onboarding and all of the wealth that is held within those structures does need to be disclosed and reviewed via independent audit. So it's as robust as it would be anywhere else in the world. As I say, we may be small, we punch above our weight, so we are double squeaky clean when it comes to that onboarding and recognizing global sanctions and all of the bits and pieces. So we don't make it easy for people, but it can be quick if people are prepared. So no, it doesn't come at the consequence of quality. I can see we've got a couple of questions popped in as well.
Yeah, we do. And I'll quickly, Kerry, and jump into taking these questions. Hi, everybody. Firstly, thank you to Jason and the NY All team. Kerry, thank you very much for moderating a very good session. So, Jonathan, I'll post this to you. There's a question: is there a minimum AUM that is ideal to start considering the DFSA registration?
No, but it didn't used to be the case, because if it depends on which side you're looking at. If you're a manager, we used to be a great center. If you had $50 billion and you want to take a floor plate in our shiniest tower, which is right behind Asfa's head there, I see. And actually, the commercials for a smaller manager didn't really work, but we spent a lot of time the last few years changing that and giving optionality. So we have firms that are setting up with $10 million that work, because actually we've built the DFSA fund center. We've removed the closed office requirements in a facility that we've built, but it's secure. It has soundproof room. Actually, we spent a lot of time, Chris and I, working on this project, so working across the two authorities to make that. So actually, when a firm can come and start out with one individual working for them, and I won't go into what the rest of that looks like in here, but we can share that detail, then actually you can have a small AUM to start. And if the question on AUM is, if you're a family office setup, you need $50 million of investable assets, but it doesn't need to be held in the structure. So actually, there's a lot of flexibility on both sides, so you can sort of pick and choose. But we are just as welcoming to the Citadels of this world, who were authorized a month ago, as we are to a $10 million VC firm. Thank you.
Excellent. There's another one. Are you seeing family offices being more open on taking on debt and engaging in LBO similar to private equity, or more so focused on VC, growth equity, and direct investments?
The short answer is yes, because it's now a global family office hub rather than just regional. It means that to be a global family office hub, it means parts of that family have probably moved. So with them, they've brought their investment appetite. So, example I use a lot. I was in Hong Kong a few months ago, and the guy says, "Why would I move to DFSA? All of my clients are mainland Chinese." Great. There's 400,000 Chinese within the UAE and 150,000 high net worth. Just sell to them. But what have they brought? They've brought the investment profile that they had from China, and that's just one example. We've got 190 countries represented within the DFSA alone. So actually, private debt, and you've got a client profile that you look for. That client profile now exists in the UAE and exists in the DFSA. So you don't need to reinvent your business model. You can just replicate it on a different scale, smaller, larger, whichever works. But certainly, private debt, private credit. That whole space is really increasing in allocation.
Excellent. We'll give it a couple of more minutes if anybody has any other question. Otherwise, Jason, I think we're reaching the hour mark and we can wrap it up.
Yes, I will say thank you, everybody, so much for attending. Thank you guys for putting on this discussion. It was extremely interesting, exciting, and can't thank you guys enough. Have a great day, everyone.
Thank you.
Thank
Thank
you.
you.
Thank you, everybody.
All right. Thank you.